This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 24, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is teetering on a knife edge, hovering mere dollars above its 5-day low of $735.21 as a violent sector rotation tears through the tape. With the Nasdaq 100 compressing tight against its July 17 lows and the VIX suppressing fear at 16.64 despite a 1.9% sweep in QQQ, the market is presenting a classic divergence. Price is crashing, but volatility is asleep at the wheel. On the calendar, the immediate focal point is the earnings queue for Friday, July 24. The headline act is American Express, reporting Q2 results with estimates around $4.41 per share. We also have Amcor Technology and Edwards Lifesciences in the mix, alongside the chaotic pre-open situation with Charter Communications. Apex, what's the priority watch for the opening bell?
The priority is clearly the structural damage from Charter Communications. While AXB provides a snapshot of consumer spending health, CHTR pre-market gap down to $111.64 is an active bleed that is dragging the entire communication services sector. That is the live wire we need to monitor for spillover effects into the broader market liquidity.
Let's look at the broader landscape. As of 9:19 ET on July 24, 2026, the major indices are in the red. SPY sits at $738.18, down 1.23%. QQQ is lighter at $691.96, off 1.9%. The Dow is relatively calm at $516.26, down just 1%, and small caps in the Russell 2000 are at $292.09, down 0.58%. But if you want to see the true extent of the rot, look at the sector ETFs. Consumer discretionary is collapsing at $108.76, down 4.61%, while communication services is down 3.5% to $105.38. Meanwhile, industrials, the industrial sector, are up 1.73% to $181.94, and healthcare, the healthcare sector, is up 1.26% to $161.44. The VIX is at 16.64. Let's get into the analysis. The driving force behind this equity sell-off is idiosyncratic yet systemic. Charter Communications is gapping down 11.8% to $111.64 on reports of customer losses. Simultaneously, Amcor Technology is surging 11.2% to $72.62, likely driven by strength in the semiconductor supply chain linked to Intel and SAP. Apex, how do these divergent moves shape the narrative?
It shapes a narrative of fragmentation. You have a massive risk-off event in CHTR dragging down the growth/consumer complex, while Amcor is rallying on hardware-specific demand. It's not a uniform market downturn. It's a capital redistribution. The money flowing out of cable/tech growth is looking for safety in industrials and healthcare, hence the industrial sector strength. It's a clean split between speculative growth and tangible assets.
Grid, looking at the SPY $738.18 price point, how does this CHTR-driven chaos interact with the technical setup?
It complicates the support test. SPY is at $738.18, sitting just $3 above its 5-day low of $735.21. Normally, a specific stock like CHTR might cause noise, but when it drags a sector down 3.5% like communication services is doing, it amplifies the selling pressure on correlated names. The technical structure is fragile because the volume anchors are shifting. Pre-market volume is heavy in CHTR and Amcor, meaning the liquidity pools are thinning in the weak hands. If SPY touches $735.21 with that kind of sectoral drag behind it, the probability of a breakdown increases significantly.
Let's dig into the indices. SPY is at $738.18, approaching the critical $735.21 support. QQQ is at $691.96, with a wider cushion, but heading toward its 10-day low of $686.76. Grid, walk me through the mechanics of this compression.
We are seeing a textbook breakdown preparation. For QQQ, the price is $691.96, which is only about $5 away from the July 17 low of $686.76. That creates a narrow corridor. Algorithmic traders love these compressions because a single large sell order can trigger stop-loss cascades. For SPY, the $735.21 level is the line in the sand. A close below that invalidates the consolidation pattern established since late July. Right now, SPY is holding, but the lack of volume on the upside means it's coasting. The danger isn't the level itself, it's the exhaustion of buyers trying to defend it.
And that's where the VIX data becomes dangerous. You're talking about technical levels, grid, but the VIX is at 16.64, down 0.41 points from yesterday. SPY is down 1.23%. That is a negative divergence. Price is falling, but implied volatility is contracting. This tells me the options market is not pricing in the risk that the tape is showing. When VIX suppresses during a sell-off, it usually means dealers are comfortable providing liquidity, but that comfort is fragile. Once SPY breaks $735.21, that VIX won't stay at 16.64. It will snap back to the upper end of its 5-day range, which is 19.5, potentially much faster.
I agree on the fragility, but don't confuse the lagging indicator with the leading signal. The VIX is reacting to the volume of hedging, which hasn't spiked yet because the breakdown isn't confirmed. Until SPY closes below $735.21, the VIX suppression is just noise. My job is to track the price action, and right now the price action is respecting the $735.21 floor, albeit barely.
Respecting the floor doesn't mean the foundation isn't cracking. The 10-year 2-year spread is flat at plus 0.34 pp. That macro environment structurally penalizes the growth stocks dominating QQQ. You're waiting for a technical confirmation, but the fundamental support is evaporating due to sticky inflation. Core PCE is at 3.41%. CPI is at 3.46%. The market is realizing the Fed funds rate of 3.63% isn't coming down anytime soon. That's why the VIX is low. It's complacent, not cautious. Complacency breaks harder.
Pulse, help us understand the human element here. Are traders aware of this divergence, or are they missing the risk? They're missing it entirely, and that's the trap. We're seeing a classic volatility compression mindset. Retail sentiment is skewed by isolated bright spots. NVDA and MSFT are showing bullish news sentiment, up 0.51% and 0.52% respectively. But look at TSLA, down 0.38%, and Opal, down 0.27%. The broad market sentiment is turning risk-off, but the individual stock winners are distracting from the aggregate decline. The put/call ratios aren't spiking because people think this dip is buyable. They are ignoring the consumer discretionary collapse because they're fixated on the few green tech names. It's a bias distortion. The crowd believes the VIX at 16.64 means safety, when it actually means everyone is unhedged against the very break grid is watching.
That's the behavioral piece I'd expect, but let's be precise about the dip buyable narrative. QQQ is down 1.9%. That's not a dip, that's a trend reversal in progress. The 10-day range for QQQ is $686.76 to $726.39. We are at $691.96. There is almost no room left on the upside from current levels to justify a buy the dip thesis. The math doesn't work for long entries here unless we see a reclaim of $740 on SPY with volume, which we haven't seen.
Exactly. And the volume tells me the bulls are exhausted. Without fresh inflows, the path of least resistance is down. The sentiment isn't just complacent, it's trapped. People who bought the July 21-22 consolidation are now underwater, and once that support breaks, they become sellers themselves. Let's pivot to the sector divergence. We have consumer discretionary down 4.61% to $108.76, and communication services down 3.5% to $105.38, while the industrial sector is up 1.73% to $181.94, and the healthcare sector is up 1.26% to $161.44. CIPHER, what is happening in the flows here?
This is a violent regime shift. We are seeing a structural rejection of the consumer narrative. The CHTR event, with its 11.8% gap down to $111.64 on customer loss headlines, is the catalyst, but the reaction is broader. Consumer discretionary isn't just down, it's collapsing. This indicates that institutions are unwinding exposure to high-beta consumer cyclicals. At the same time, capital is flowing into tangible assets. The industrial sector and the healthcare sector are gaining. This isn't random selling, it's a rotation from growth/consumer to industrial/healthcare defensives. The spread between the best sector, the industrial sector, and worst, consumer discretionary, has widened to over 6 percentage points in a single day. That is a correlation break.
And that correlation break is the key. When consumer discretionary and communication services move in tandem against the industrial sector and the healthcare sector, it signals a change in market preference, not just stark selection. The money is leaving speculative consumption and moving to essential services and infrastructure. From a portfolio construction standpoint, this invalidates strategies that rely on consumer discretionary momentum. The fundamental backdrop of sticky inflation makes those high-multiple consumer stocks vulnerable.
Precisely, and look at the earnings signal from American Express. AXB is down 4.8% to $324.60 pre-market. Earnings per share estimates are $4.41. A weakness in a credit card issuer like AXB often presages a slowdown in discretionary spending. That reinforces the consumer discretionary breakdown. It's not just CHTR fault anymore. The data suggests the consumer is pulling back across the board.
Technically, this sector rotation accelerates the pressure on SPY. Consumer discretionary is a heavy component of the S&P 500. A 4.61% drag from that single sector weighs heavily on the index. It's not just about CHTR, it's about the weight of the laggards. The SPY support at $735.21 is being tested not just by broad market selling, but by the mechanical weight of these out-of-favor sectors. If consumer discretionary continues to degrade, it pulls the index down regardless of what the industrial sector is doing.
Which brings us back to the risk. The VIX is at 16.64, but this sector bifurcation is a stress test for correlation models. If the rotation holds, if consumer discretionary keeps bleeding and the industrial sector keeps supporting, the VIX might stay low for longer than expected, but the divergence in returns will widen. This is a rich-poor dynamic. The indices might hold, but the underlying composition is changing rapidly. Traders holding broad baskets are getting crushed, even if SPY looks stable. The risk isn't just a crash. It's a slow grind where alpha is destroyed by sector mismatch.
Agreed. And sentiment-wise, the rotation is painful for growth-focused investors. We're seeing NVDA and Meta holding up, but the broader tech complex is struggling. The sentiment score for the sector is turning negative. Retail investors who are long growth funds are facing drawdowns that are accelerating. You'll see increased frustration in social sentiment feeds as people realize their safe tech plays are moving in lockstep with the failing consumer sector.
So the takeaway for the indices: SPY needs to reclaim $740 to show any relief. Until then, $735.21 is the attractor. If it fails, we look at the triple Q low of $686.76. But the sector divergence suggests that even if SPY bounces, triple Q might continue to lag because the growth constituents are heavier in these weak sectors.
To synthesize, Grid is flagging the technical fragility of $735.21. CIPHER is confirming the fundamental rotation away from consumer growth, and SPECTER warns that the VIX suppression is hiding the correlation risk. The convergence is that the current support levels are being tested by a structural shift, not just noise. The data shows a market that is actively rejecting growth valuations in favor of defensive value.
Here is our summary for this pre-market session. First, the S&P 500 is testing critical support at $735.21, a level that, if broken, could accelerate downside momentum given the current technical compression. Second, the market is undergoing a severe sector rotation, with consumer discretionary, down 4.61% and communication services, down 3.5%, driven by the CHTR catalyst and broader risk-off flows. Third, the VIX remains suppressed at 16.64 despite the equity declines, creating a negative divergence that historically precedes volatility expansion. The key dynamic to watch is whether SPY can hold $735.21 on Monday's open, or if the sector pressure forces a breakdown. Tomorrow, the focus shifts to whether the rotation into industrials, the industrial sector, and healthcare, the healthcare sector, can sustain their gains as the broader market digests this shock. Thank you for listening to ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.